1 minute ago, a political shockwave hit North America. Former President Donald Trump has threatened to impose a 100% tariff on Canadian imports if trade negotiations fail to meet U.S. demands. Within minutes of the statement, markets reacted, stock futures slipped, oil prices turned volatile, and the U.S. dollar surged sharply against major currencies. Is this a negotiation tactic or the beginning of a new North American trade war? Tonight, we break down what happened, why markets reacted instantly, and what this could mean for the U.S., Canada, and the global economy. Stay with us. According to early reports, Trump warned that if Canada does not comply with revised trade terms, his administration would consider imposing a 100% tariff on select Canadian goods. A 100% tariff means the price of affected imports would effectively double. That is not symbolic, that is economic escalation. Canada is one of America's largest trading partners. The two countries exchange hundreds of billions of dollars in goods every year under the framework of the United States-Mexico-Canada Agreement, often referred to as USMCA. Major industries that can be impacted include energy exports, automotive manufacturing, lumber, critical minerals, agricultural goods. A move this large would disrupt deeply integrated supply chains that have existed for decades. Supporters argue this is a negotiation strategy. Trump has historically used tariffs as leverage, especially during disputes involving trade imbalances or industrial policy concerns. A 100% tariff threat signals maximum pressure. The message is clear: comply or face severe economic consequences. But critics argue such measures could backfire because the U.S. and Canada share one of the most interconnected economic relationships in the world. Auto parts cross the border multiple times before a vehicle is fully assembled. Energy flows both directions. Supply chains are deeply intertwined. A tariff at that level doesn't just hurt exporters. It affects manufacturers, retailers, and consumers on both sides of the border. Markets moved quickly. Stock futures dipped shortly after the announcement. Investors rotated towards safe haven assets. The U.S. dollar strengthened. Why? Because in times of uncertainty, global capital often flows toward perceived stability. And despite the volatility, U.S. Treasury assets remain a global safe haven. Meanwhile, commodity markets reacted with caution. Oil prices fluctuated due to Canada's role as a major energy supplier to the United States. If tariffs were imposed on energy exports, refiners and industrial buyers could face immediate cost pressures. Currency traders also reacted. The Canadian dollar showed signs of pressure in early trading. This kind of reaction reflects fear of slower trade flows and economic disruption. Markets don't wait for policies to be signed. They price in risk immediately. Let's break this down practically. If a Canadian product currently costs $10,000 wholesale, a 100% tariff could add another $10,000 in duties. That cost does not disappear. It moves through the supply chain. Manufacturers may absorb some of it. Retailers may pass it on. Consumers may ultimately pay higher prices. Economists warn that such measures could increase inflation, disrupt manufacturing supply chains, slow cross-border investment, trigger retaliatory tariffs, and retaliation is key. If Canada responds with its own tariffs, U.S. exporters could be targeted. Agriculture, machinery, and industrial goods could all be affected. Trade wars tend to escalate quickly once both sides respond. That depends on whether this is a tactical warning or a policy commitment. Historically, tariff threats are sometimes used to accelerate negotiations, but markets treat every threat seriously until clarity emerges. If Canada retaliates, or if negotiations stall, this could expand beyond bilateral tensions. Other global trading partners would be watching closely. Investors worldwide would reassess North American trade stability, and volatility could increase significantly. This is not just an economic story. It's a political one. Trade policy has become central to domestic economic messaging. Supporters view aggressive tariffs as protection of domestic industry. Critics argue they risk higher consumer costs and economic uncertainty. With economic stability already a key concern for voters and investors, the timing of such a threat amplifies its impact. Now, all eyes turn to Ottawa. Will Canadian officials respond with countermeasures? Will negotiations intensify behind closed doors, or will this remain a high-pressure bargaining tactic? Markets will be watching for official government statements, clarification on scope and timeline, signs of retaliation, movement in currency and equity markets. Until clarity arrives, volatility may continue. A 100% tariff threat is not minor policy noise. It is a major economic signal. Tonight, markets reacted first. Governments respond next. We will continue tracking developments as they unfold. If you want real-time updates on breaking political and economic shifts, make sure you stay tuned. This story is developing.